Welcome back to Nomad Investing. Today we are looking at the heavy lifter of the semiconductor industry, Synopsys, ticker SNPS. If you follow my channel, you know we like companies that sell the shovels during a gold rush. Well, Synopsys sells the digital blueprints and the testing grounds for the entire AI revolution. Whether it's Nvidia, AMD or Intel, they literally cannot build their chips without the software Synopsys provides. But the company has gone through the biggest transformation in its history by acquiring Ansys. Today we're going to see if this new massive entity is a compounder for your portfolio or if the valuation has gotten ahead of reality. We'll break down the new financials, the hidden debt risks from the merger, and my intrinsic value estimate. Overview. First, let's demystify what this company actually does. Synopsys operates in an industry called EDA, which stands for Electronic Design Automation. To explain this simply, imagine you want to build a modern skyscraper. You wouldn't just grab a shovel and start digging. You would first need incredibly complex architectural software to design the structure, test it if it can withstand an earthquake, and figure out exactly where every pipe and wire goes before you even pour the concrete. Synopsys provides that software, but for computer chips. Modern chips have billions of tiny switches called transistors on them, and it's physically impossible for a human to draw these by hand. Engineers use Synopsys software to write code that describes what the chip should do, and the software translates that into the microscopic blueprints used by manufacturing. Without this software, companies like Nvidia, Apple, and AMD literally cannot exist. They make money through two main engines. The first one is design automation, which is that core software suite engineers use to design and test the chips. This is a massive heavy lifter for the company, bringing in about 65 to 75% of their total revenue. It is a steady grower, typically clocking in 15 to 20% growth year over year, making it a reliable backbone of the business. The second engine is design IP, or intellectual property. Think of this like buying pre-made parts for your car. Instead of designing a standard USB port or a Wi-Fi interface from scratch every time, chipmakers pay Synopsys to use their pre-verified designs because it saves them time and money. This segment accounts for roughly 25% of the revenue. Historically, this has been a rocket ship for them, but recently it has faced some headwinds, seeing a slight decline or slower growth due to China export restrictions and delays at major foundries. However, the long-term trends here remain strong as chips get more complex. When we look at their position in the industry, this is a classic duopoly, or a two-horse race. Synopsys is the market leader with roughly 38 to 40% of the global market. Their primary rival, Cadence Design Systems, is hot on their heels with about 36%. Together, these two control nearly 75% of the entire industry. If you want to build a chip, you almost certainly are paying one of them. There's a distant third player, Siemens EDA, which holds about 13%. But Synopsys and Cadence are the undisputed kings. In the design IP market specifically, Synopsys is the number 2 player globally, right behind ARM's holdings. But since ARM focuses mostly on processors, which are the brains, and the Synopsys focuses on interfaces, which is the nervous system, they often complement each other rather than fighting directly. In a massive move to dominate the industry even further, Synopsys recently acquired Ansys for approximately $35 billion. While Synopsys focuses on the electronic inside the chip, Ansys is the king of simulation, testing how products handle heat, fluids, and physical stress in the real world. This merger creates a silicon to systems powerhouse, meaning they now control the entire workflow from initial digital code all the way to the physical product performance, making them even more essential to customers like Nvidia and Tesla. Now let's move on to the financials. Let's look at the numbers. For the basics, in fiscal year 25, their reported earnings per share took a hit due to the massive costs of buying Ansys, coming in around $8. However, the non-cap earnings, which is what Wall Street really watches because it ignores those one-time merger costs, remain significantly higher, usually in the 13 to 14 range. The stock currently trades as a PE ratio of roughly over 60, and with a forward PE ratio of roughly 35. This is a premium price tag, meaning that the market is already expecting massive growth from this new merger. They pay zero dividends because they reinvest every single penny back into research and buying other companies. Short interest is very low, sitting just above 2%. This tells us that the smart money is not betting against this company right now. Their market cap is currently valued around 100 billion. If you look at the past 5 years, the trend is relentless. They have compounded revenue at roughly 15% annually, jumping from around 3.6 billion in 2020 to over 7 billion in the fiscal 25. Their earnings have grown even faster than revenue, often growing 20% or more year over year. This shows they have operating leverage, meaning for every $1 of new sales, they keep more profit. Historically, this company has been a cash machine. However, in 2024 and 25, we saw their free cash flow yield compress to around 1.3 to 1.5%. This is a temporary dip caused by the transaction costs and interest payments related to the merger. Overall, the free cash flow has grown a lot, just the yield is quite low. This brings us to debt and efficiency, where the picture has really changed. Before Ansys deal, Synopsys was a net cash positive. Now to fund that 35 billion acquisition, they have taken a significant leverage. Their average debt has ballooned to around 14 billion. Consequently, their leverage ratio has spiked. While they historically ran near zero debt, they are now managing a real debt load for the first time in years. Finally, their return on invested capital, or ROIC, has dropped to roughly 3% recently. But do not panic yet because it's a mathematical quirk. They increased the invested capital part of the equation significantly with this acquisition, but the full returns and profits from Ansys haven't fully kicked in yet. Historically, they average a stellar 12 to 17%. So you want to see this number climb back up to above 10% in the next 2 years as they integrate the new business. Now let's move on to the future. Now for the future, the story of what could go right and what could go wrong. The bull case here is what they call silicon to systems. This is their main differentiator. By acquiring Ansys, Synopsys has effectively built the only platform that allows you to design the chip, the board it goes on, and the car it drives all in one loop. While their competitors like Cadence are scrambling to build similar stacks, Synopsys now owns the deepest and broadest portfolio in the industry. They're betting that as chips get more complex, customers will just want one vendor who can do it all, securing their dominance for the next decade. But we also have to talk about the risks, and they're serious. First is the China problem. We all know Nvidia is banned from selling the best chips to China, but people forget that Synopsys is in the same boat. Roughly 15 to 20% of their revenue comes from China. If the US government decides that Chinese companies shouldn't even have the software to design the chips, Synopsys could face an overnight export ban. They are a geopolitical football, and that revenue stream is far from guaranteed. Then there's the competition. For years, Synopsys and Cadence have enjoyed a friendly duopoly with incredible 30% profit margins. But Cadence is aggressive and they have very similar technology. If this rivalry heats up and turns into a price war to win customers, those beautiful profit margins will be the first thing to collapse. Synopsys has to prove that their new super platform is actually better, not just bigger. Because if the customers don't see the difference, they will just go whoever is cheaper. Finally, there's the integration of Ansys. They spent $35 billion on this. If they can't merge these two massive corporation cultures smoothly, or if the engineers start leaving for competitors, they will have paid a fortune for a headache, destroying shareholder value in the process. Now let's estimate the intrinsic value. So what is the company actually worth? This is where it gets tricky. We need to talk about the trap. When you open a financial website, you are going to see two different earnings per share numbers. First is the non-cap, which is currently sitting around $13 to $14. This is the number Wall Street loves to quote because it conveniently ignores one-time costs. The other number is cap EPS, which is much lower, around $8. The massive difference between these two numbers comes down to stock-based compensation. Synopsys pays its engineers a huge amount of stock. Last year alone, this expense amounted to over $5 per share of hidden costs that the non-cap number pretends doesn't exist. But here's the reality. That is a real cost to you. If they issue more stock to employees, your slice of the pie gets smaller. That is dilution, pure and simple. So for our valuation, we are going to use the honest GAAP EPS of $8.13. Now for the growth. Analysts are estimating 10 to 18% growth in the short term, and I have no doubt they will grow given the booming chip industry. Of course, assuming no major geopolitical disasters like China export ban. However, I prefer to be safe. I will conservatively estimate growth of 12% for the next 5 years, and then slow it down to 8% for the next 5 years after that. And as always, I demand 12% return on my money. Finally, we need a terminal multiple. The valuation has been all over the place lately, from highs of around 70 to lows of 32, with the median around 48. I do believe they deserve a premium valuation because of their full stack dominance that competitors can't easily match. But I refuse to pay a 70 multiple on 12% growth. I will stick to the lower end of the range and use a PE ratio of 32. And remember, as always, this is not investment advice, so do your own research. When we run the math with these numbers, we get an intrinsic value of around $300. That makes Synopsys look significantly overvalued at today's price. If you use the inflated non-cap numbers, the math would spit out a value nearly $500, which is why some people are buying here. But you have to remember that stock-based compensation is real money coming out of your pocket. To summarize, Synopsys is the ultimate shovel seller for the AI revolution. Companies like Nvidia, AMD, and Apple literally cannot exist without their software. They possess a massive moat, operating the strict duopoly with Cadence and controlling nearly 75% of the market with them. The recent $35 billion acquisition of Ansys is a game changer, giving them the only complete platform to design the chip and simulate its physical performance, which supports their relentless track record of compounding revenue at 15% and earnings at a 20% annually. However, there are serious risks. To fund this deal, they took a massive debt load of around $14 billion. There is also geopolitical threats, as 15 to 20% of their revenue comes from China, making them vulnerable to export bans. Most importantly, investors must watch the hidden cost of stock-based compensation. There is a massive gap between the Wall Street non-GAAP EPS of $13 to $14 and the real GAAP EPS of around $8. This difference is largely due to paying employees in stock, which amounted to over $5 per share last year, a real expense that dilutes your ownership. Ultimately, while Synopsys is a high-quality compounder, the valuation is stretched. If you value the company using honest GAAP numbers that account for this dilution, the intrinsic value is roughly $300 per share. With the stock trading around $500, the market is pricing perfection and ignoring the real cost of stock options. It is a wonderful company, but right now it's a very expensive stock, and that is why I am not buying. Well, what do you think? Is Synopsys going to grow more and I'm just being way too conservative? Let me know in the comments. And also hit the like and subscribe for the algorithm. And as always, do not lose money and safe travels.